Waiting to break even is costing you a fortune. The Sunk Cost Fallacy. Good morning, investors. I want to start today with a simple scenario, and I want you to think about whether you recognize yourself in it. You invested in a thematic fund 18 months ago. The story was compelling. The returns had been strong. Everyone was talking about it. And then the market shifted. The fund corrected. And today, 18 months later, you are sitting on a loss of 15 or 20%. Now here is the question. Why are you still holding it? If you are honest with yourself, is it because you have analyzed the fund's future prospects and concluded it deserves your continued investment? Or is it because you simply cannot bear the idea of exiting at a loss? If it is the second, you are in the grip of one of the most well-documented biases in all of behavioral science. And it was named and proven in a landmark paper published 40 years ago. In 1985, psychologists Arkes and Arkes Blumer published a paper in the journal Organizational Behavior and Human Decision Processes titled The Psychology of Sunk Cost. Their experiment was elegant in its simplicity. They worked with a university theater that gave randomly discounted season tickets to customers who had just purchased them. Some paid full price, others received a discount randomly assigned. No one knew others had paid differently. Over the following months, they tracked how many performances each customer attended. The result was striking. Customers who paid full price attended significantly more performances than those who received discounts. And not just in good conditions. They attended during bad weather. They attended on inconvenient evenings. They made the effort repeatedly that the discounted customers did not. Now here is what makes this finding so important. The rational calculation for attending any given evening should have been identical for everyone, regardless of what they paid. The ticket money was already spent, already gone. Whether you attend or stay home, the money does not come back. The only question that evening should have been, do I want to go to the theater tonight? But that is not how the human mind works. The full price customers felt compelled to get their money's worth. The desire not to appear wasteful to themselves, not even to others, drove their behavior long after the money had already been spent and could not be recovered. Arkes and Blumer called this the sunk cost fallacy, the tendency to continue investing time, money, or effort into something not because the future looks promising, but because of what has already been spent. Because walking away feels like admitting the original decision was wrong. How it sounds in investing. Let me give you 3 sentences. Tell me honestly if you have ever said any of them. I cannot exit this fund now. I am down 20%. I will wait until I break even. I have held this fund for 3 years. I cannot just give up on it now. I put too much money into this to walk away. Every one of those sentences sounds completely reasonable, prudent, even, patient. Every one of them is the sunk cost fallacy in its most expensive form. The loss that is already on paper, the 15%, the 20%, whatever the number is, has absolutely no bearing on what that fund will do going forward. None. The market does not know what you have paid. The fund does not know how long you have been holding. Your original investment decision is not a factor in what this fund does tomorrow or next year. Holding it because you have already held it is not patience. It is not discipline. It is the desire not to appear wasteful to yourself, dressed up as investing wisdom. The Indian data. This is not a theoretical problem for Indian investors. The numbers from 2024 and 2025 tell the story clearly. In 2024, 34 out of 425 equity schemes delivered negative returns on SIP investments. The Quant PSU fund reported a negative extended internal rate of return of minus 20.28% on investments made at the start of the year. Thematic and sectoral fund AUM grew 79% during 2024, from 2.58 lakh crore to 4.61 lakh crore, as investors poured money into exciting themes at peak valuations. When those themes corrected sharply in 2025, many of those investors stayed in, waiting, holding, not because the fund's future prospects justified staying, but because exiting meant confirming a loss they were not ready to accept. Across thousands of portfolios, in thousands of families, the same sentence was being quietly repeated. I will exit when it comes back to what I paid. And while they waited, time passed, opportunity cost accumulated, better investments remained uninvested, and the fund, indifferent to their patience, continued to do what it was going to do regardless. The right question. Here is the single most important shift you can make in how you think about an underperforming fund. Stop asking, how much have I lost? Start asking, does this fund deserve my money going forward? Those two questions look similar. They are completely different. The first looks backward at the sunk cost, at the loss, at what had already been spent. It is a question that produces paralysis and continued holding, regardless of the fund's future. The second looks forward at what this fund is likely to do from here, at whether better alternatives exist, at whether your money is in the right place for the future you are trying to build. Only the second question produces a rational investment decision. And here is the practical test I suggest to every investor. Take any fund you are holding at a loss and ask yourself honestly, if this money was sitting in cash in my bank account today and I had a completely free choice, would I invest it in this fund? If the answer is yes, hold with genuine conviction. You have made a considered, forward-looking decision. If the answer is no, the sunk cost is making your decision, not your analysis, not your financial plan, just the desire not to admit a mistake. And admitting a mistake, exiting a bad fund and redeploying into a better one is not losing. It is the most rational, most disciplined thing an investor can do. The real lesson. Arkes and Blumer proved in 1985 what every experienced investor eventually learns the hard way. We are not rational about money we have already spent. We feel compelled to justify past decisions rather than make better future ones. The money you have already lost is gone, whether you stay or exit. That is the uncomfortable truth at the heart of the sunk cost fallacy. The only question that matters now is, what gives your money the best future from this point forward? My Wealthwise pin-up rule for today. Never let what you had already spent decide what you do next. Sunk costs are history. Investment decisions or about the future? Tell me honestly in the comments. Have you ever held an underperforming fund simply because you could not bear to exit at a loss? What was the fund? How long did you wait? This is one of the most universal patterns in investing, and naming it is the first step to breaking it. I am MV Suresh, founder MV Suresh Wealthwise. For regular mutual fund updates, connect with me on Facebook, Instagram, LinkedIn, YouTube, and Telegram. Wishing you good financial health. I'll be back tomorrow with a new tip. Till then, stay wealthwise.